Hi, thanks for stopping by again. Appreciate you coming into all the things we're doing. Basically today I wanted to go ahead and answer a particular comment that we received on a couple of the video here. It was from Sue Haley 1, a subscriber, and she said, would you please go ahead and describe a little bit more about some financing? Now Sue, I'm not exactly sure how far into the financing you've got, but I'll tell you the things that I tell the agents that work for me, and then maybe that might be able to help you out in figuring out where to take your real estate career as well. So as far as financing is concerned, there's a couple things I think you need to understand, okay? The thing about real estate financing, okay, is that there's a couple things that are going to separate you from your competition, and one of those is going to be financing and financing knowledge. You see, when you can show a seller that you know how to make a deal happen, okay, versus an agent who doesn't necessarily know, some of the different ways that they can finance a home, maybe other than just the traditional, then of course you're going to come out a little bit better. When you're dealing with a buyer who has really been looked at from other lenders and is not really able to qualify traditionally, then you can find a way to make it happen, then great, you got yourself a sale. But the fact is that, financing in any way, shape, or form is always going to make you look better. And so that's why the financing itself is so much more important to know. Now, when you start working with me and you start working at my team, the first thing I always tell you is to go ahead and find a lender that you like, okay? Find a lender. Find a lender that's going to be competent in the traditional types of financing, okay? Those would be obviously, your conventional financing. And Sue, or if anybody who's watching this is not very familiar with the different types of financing, conventional loans are simply the easiest loans to go ahead and obtain generally. They are not federally backed. They don't generally have too many requirements. They usually require anywhere from 5 to 20% down, depending on what kind of loan you get. Okay. Now, on the other hand, the next traditional would be the FHA financing. FHA financing is simply Federal Housing Administration loans, and those are backed by the government. They're backed by HUD, Housing and Urban Development, and they require, in these days, 3.5% down payment. So this is a really good program for people who are starting out, maybe buying their first home. Then, of course, the last would be a VA loan. Okay, now these are really restricted to people who are veterans, who have been honorably discharged. They have to have what's called a DD-214. Okay, a DD-214, okay, is the form that demonstrates that they had been discharged honorably, or that they are in current good standing if they're an active duty member. The DD-214 is primarily if they have served and they're out. It serves as proof that they're entitled to this benefit. The VA, loan, as you remember from school, if you were a real estate agent, if you're not a real estate agent, yet you're contemplating on going to real estate school, the VA loan is essentially zero down, okay, but they do have what's called a funding fee. Now the funding fee, okay, it can be wrapped up into the loan. And the funding fee itself takes the place of a down payment and mortgage insurance in a sense, okay? So let's pretend that they're buying a $100,000 house, okay? Depending on how many times they've used a VA, okay? If they've used the VA and it's the first time, I'm not necessarily 100% sure on this, so check it with your lender. But if I'm not mistaken, their funding fee is 2.5%, okay? That gets wrapped into their loan, which is $102,500. Okay, they don't have to come up with any money down, all right, but their loan balance is $102,500, okay, and that's simply because of their funding fee. If, on the other hand, the veteran is more than 30% disabled, okay, if they're more than 30% disabled, then they do not have to pay the funding fee. So whenever you're talking to a veteran who is retired, who is out of the service for some reason or another, may not be retired, maybe they got discharged for some reason or another, when you're talking about using their VA benefit, ask them if they were disabled in any way. If they were disabled, if they were over 30%, then they're able to go ahead and save money on that funding fee because they don't have to pay it, and that, as you can see, can work out to be quite a bit of money. Okay, so that is more of your traditional types of funding. Okay, now, so what I always tell the agents that work for me to do is obviously go find a lender that can make you smart in these areas. Okay, this is probably step one where most agents do not take. Most agents come into the business, they do not focus on any kind of knowledge in financing. They don't care, they just kind of feel their way through. When I tell my agents, look, you need to go find a lender who's going to make you smart to this kind of stuff, that immediately gives you the advantage over most of the agents who do not take this step. Okay? So remember, conventional, 5% down is the typical, 20% down if they want to avoid mortgage insurance. FHA is typically 3.5% down. That is federally governed, a federal program that is backed by HUD. The VA is typically ran actually by the Veterans Administration for veterans only. Remember, with the VA, there is a funding fee. So that's the traditional stuff. Now, more into the non-traditional stuff. Now, Sue, I think one of the questions that you had was, can you go more into the other financing? Now, we talked about some of the conventional types of things, and I think your question is, hey, what is it that is non-traditional? What are some of the things I can do to help finance a home? Well, the financing of a home itself, okay, is not all that hard if you know how to do it, okay? So like I mentioned before, the first thing you want to do is just find a regular lender, all right? Ask around your agency, ask around your office, and find out who the agents are and who they like. Okay, if you have an affiliate, ask the affiliate. If there's some particular name in town that you're familiar with, then use them. But what I would also do is find maybe somebody who's a little bit smaller, okay, who can, come up with some creative financing. And if you're in Tucson, Bill Anastopoulos is a great guy to use, is who I recommend for any kind of creative financing. He's a great guy to know. He knows almost everything there is to know about financing. And I'll tell you, if you have a deal that's not working out very well, then Bill's a good guy to know, okay? But the creative financing side is where you start getting into other things, okay? When you start talking about owner carrybacks, okay? When you start talking about 80/20s, when you start talking about adjustable rate mortgages, when you start talking about things like hard money, when you start talking about profit sharing, then that's when you need to know a person who is really good at these sorts of things, okay? Because most realtors are a lot like most lenders. Most lenders, they'll go get their license, they'll get their training that they're required to take, they'll get their license, and they'll hang around the office, and they'll go ahead and hang out with the people that they know, take the courses that they take, and they deal with 99.9% of the financing, and they don't ever really need to step out of the box, okay? And there's nothing wrong with that. But there does come a time when you need to have a special creative financing method to sell a home or to bring a buyer to the table, okay? So it's important to have that one person that you work with. It's great if they can handle everything. Use that person. But if, on the other hand, they are so busy doing the other things that they don't really get into the conventional vanilla type stuff, then at least have a working knowledge of who they are, okay? So let's go over some of these other things. Owner carrybacks, okay, we talked about those the other day, AKA, all right, seller financing. (80/20s), those particular loans are a little bit less popular, I should say, less available these days. In the height, okay, then 80/20 loans, all right, let me just kind of go up here. 80/20 loans, all right, were loans where the seller was able to go ahead and, the buyer was able to go ahead and get a loan for 80% of the value of the home, and then get a second loan for 20% to cover the MI, the mortgage insurance. Now, the 80% loan, okay, the advantage to the buyer is that they avoid having to deal with the mortgage insurance because 20% of the equity is paid. The other aspect that was advantageous to the buyer, not only did they save on the mortgage insurance, but it also enabled them to buy the home with virtually no money down, okay? Now, you'll be very hard-pressed to find any of these scenarios nowadays because of the current mortgage environment. There's very few sellers, mortgage companies who are willing to go ahead and perform an 80-20 loan. They want to have some skin in the game. So why do I bring up an 80-20 loan? Okay, well, let's pretend. Let's pretend, okay, that you've got a house that is worth, let's say, $100,000. $100,000, okay? And you've got it at a contract for, say, $60,000. Okay? And it does happen where sellers, for one reason or another, the home's in relatively decent shape or it needs some work, but they do need to get going and they need to go get going now, that you're able to purchase it at $60,000. Okay? Now, $60,000, okay, to get the 80% loan, okay, you need to get a loan for $48,000, if I'm not mistaken. You need to get a loan for $48,000. Then the remainder of this, $12,000, you can get from a hard money lender, okay, which I'll go into in a second. But the 80% value here is a regular conventional loan, which you would qualify for, and you go through the paperwork and then you close. You deal with the other 20% from a hard money lender or something like that, okay? That still enables you to purchase the home, okay, with no money down. You have a loan, and it's still at $60,000. How in the world can you make this happen? Well, the hard money lender knows that their total exposure is for $12,000. And if they had to foreclose for some reason, and they paid off the first to protect their equity, then they still have a home that's worth $100,000 that they purchased at $60,000. And they could turn around and resell it and make even more on their investment. So in that particular circumstance, the 80-20 loan would work. You would just have a $48,000 loan on a conventional loan with somebody else. You know, you'd have a 20% down payment that you'd obtain from hard money. Currently, the interest rates are hovering around 4%, okay? You can get, from some of the different lenders, you can get generally a couple $100,000, even at about, say, 6 to 7%, okay, for hard money loan. Is it higher than the average? Of course it is. But the person who's going to be doing the hard money loan, okay, has got to make money on that yield there, okay, that split. All right, so they're going to make money on the interest, but they're going to make money on the difference between the original interest rate, which is the market rate, and they're going to make money on that yield there. That's where they make the money. It's the privilege of using their money. Okay, so since we've brought this up a couple times, let's talk about a hard money loan. Now, a hard money loan, okay, hard money loan is nothing more than a person going out and lending you 20 bucks, okay? So if I need to borrow from you, say $20, I'm going to go buy a television and it costs 50 bucks. And I say, okay, I'll tell you what, I don't have the 50 bucks right now, but I'll have it in a month. May I borrow, say, I got 25 of it of myself, why don't I borrow the other 25 from you and I'll pay you back at the end of the month? And you say, okay, great, and you pay me 25 bucks, okay? You say, but however, at the end of the month, for the privilege of using my money, then you have to owe me not 25, but you have to pay me $30, okay? That's the same concept as a hard money loan. In this case, okay, you have a lender, okay? And what they want to do, they're really a passive investor, okay? And we can go into the different types of investors, okay? But the passive investor is the kind of guy who wants to go out. He doesn't want to have anything to do with the property itself. He doesn't want to have to do with the management. He doesn't want to have to do anything with a rehab. He doesn't want to have to do with anything with the wholesale or any of these other types of terms you hear flung about. What he wants is passive income from the money that he's lent out. And so this lender, okay, a private person generally, or maybe even a conglomeration of people, a couple doctors, a couple lawyers, they all get together, they form a fund, and they, invest property or invest money. They are going to want a certain amount of return. Like I mentioned before, anywhere from 6 to 7%, depending on the conditions. And there's also certain types of, criteria that they may want. So for example, if you're going to be purchasing a property, they may want the ARV to be 70%, okay, or less. The ARV is the assumed repaired value, the what you feel it's actually worth. If everything is perfect, we think the home is worth $100,000. They're going to say, well, we want to purchase it no more than $70,000. The reason why is because they want to make sure that their investment is protected should they have to foreclose. Okay, so the lender, also the hard money lender, is paid any way you want to. Okay, however the way is that they want to do it. Okay, you can negotiate with them. A lot of times they may be willing to take interest only for a certain period of time. They may want to go ahead and amortize it over 15 years or do a balloon payment in 5. The way that you guys can work it out that's beneficial for everybody is perfectly great. You cannot do that with a regular loan, okay? So the hard money lender is a lender that can help you with some of these other down payment assistance if you need it, okay? So speaking of down payment assistance, let's go real quickly into some other areas, okay, that are maybe a little bit less than traditional. Now, I don't know specifically where you are, but in Tucson, okay, we have things like IDA bonds, MCB bonds, USDA. We have, let's see, the SALT program, NLP program, and NSP programs, okay? All of these programs, okay, are programs that enable a homeowner to purchase a home at a lesser rate, generally. For example, the IDA bonds and MCB bonds, those are bond programs which will, if a person qualifies, can purchase a property for as little as $1,000 down. Now you have to ask yourself, if I could advertise that, okay, if I could get that out on the properties that I have for sale, a sign that says, hey, you can purchase this home for $1,000 down, you've got your Regulation Z requirements out there, that's going to increase your sales price. That's going to increase the calls that you have on this home. That's going to increase the activity you get because you make different types of financing available. Remember, if you can compete on different ways, all right, we talked about in the last lesson. If you can compete on price, great. If you can compete on condition, great. If you compete on financing and terms, that's great too. So remember, you got to be a number one in any of those scenarios. Okay, the USDA, okay, that's an FHA program. All right, we're already familiar with FHA. FHA program, which is typically rural areas. And you'd be surprised what FHA will describe as a rural area. Here in Tucson, it includes many incorporated areas as well that are perfectly what you'd look at as a city, okay? SALT programs, okay? These are primarily home programs that are allowed for first-time home buyers. The NSP is Neighborhood Stabilization Program. Neighborhood Stabilization Program, that's where a entity that's able, a government entity is able to go ahead and buy this home. In this case, SALT actually is incorrect. I had that on my head because they were a buyer for a program for NSP. I had that in my head, so please excuse that. But the NSP program is something that will allow people to go ahead, the government purchase these homes in foreclosed area, then they are able to go ahead and sell these, or buy these properties at even 1% below the appraised value. So what I would really recommend, to sum it all up, okay, there's so much more financing talk that we could talk about. And I would be happy to go ahead and continue going over this subject. But to be perfectly honest with you, I am a realtor, okay? My job is to have the general gist of the different things you can do. I know just enough to be dangerous. And what I would think would be beneficial to you as a realtor or an investor or whatever it is you choose to do is to sit down and talk with your lender, a regular lender who does, really very little outside of the box, and then go find somebody who does creative financing and say, hey, you know what? I'd like to take you out to lunch. Can you take a few minutes to make me smart about this? And they'll spend the time. They really will. And the reason why is because they want your business. Not to mention a free lunch is always fun to have. It's the best $20 you'll ever spend. They will tell you tons of things you didn't know. And don't worry about remembering everything, because although you'll remember the things, you'll take the notes and things, all you need to know is the specifics of maybe one or two programs that you can use in your presentations to the buyers, your presentations to the sellers. Those are the things that will help you go ahead and distinguish yourself from the competition, which will allow you, of course, to go ahead and get the deal done. So if you've liked this presentation, thank you so much. I hope that it's been of value to you. Please go ahead and take a minute to like, subscribe, and or comment down below, because that helps us get the word out. We're getting an awful lot of viewings on this. I can tell from Google that we're able to go ahead and get about 500. I think we've reached 500 viewings so far, which is fantastic. The channel's only been on the market, or only been on YouTube for maybe a month and a half, and we've already got 500 views. So I'm really glad about that. I think that's fantastic. Share the information. If you found something that was great, share the information. Go ahead and link that up to your comment page or whatever it is you like to do. Let them know about what we're doing, and I'll look forward to seeing you soon. Thanks a lot, and have a great day.